Well, good morning, afternoon, or I guess high noon, depending where you are around the country. Welcome to another Tri-Merit webinar. Today, we are going to be talking about breaking down OB3 or OBBBA. I never know how many B's to say, or as I think I like to call it, H.R.1. That flows off the tongue a lot better for me, but we're going to talk specifically, I'll say specifically about renewable energy, but we're going to do a quick review on some other aspects of it before we get into completely renewable energy. So I just want to thank everybody for being here. Barry, next slide, please. So I'm Randy Crabtree, CPA, co-founder of Tri-Merit. One thing I want to point out before we get too deep into this is I am also the host of the Unique CPA podcast, but Bridging the Gap Conference. And the reason I bring this up is the Bridging the Gap Conference is an annual event in July, but we are taking it on the road, half-day events around the country. And so we are doing our first one next week, a week from yesterday. It'll be on the 12th of November in San Francisco. If you want more information on that, you can reach out to info@tri-merit.com, or registration link is at the Cal CPA Society's website, and you can register there. And love to see anybody out there. It'd be a lot of fun. We're going to have a great time there. Barry, next slide. And I just want to introduce Barry Devine, who is with me today. Barry is our in-house resident renewable energy tax credit. And so, Barry, I'll let you do a quick intro.
All right, quick intro. There's a little typo on this slide here. It says 18 years, but Randy, I think you and I started doing R&D back in 2005. So yeah, I need to update 18 to 20 years. Yeah, so been a minute, been a long time, and specialty tax has been a good ride.
Actually, you've been 20 years. I've been 19. You've been in this longer than I have.
That's right.
So, but you taught me everything I know. So thank you.
There you go.
All right.
Appreciate that.
Let's move on. All right. So Tri-Merit, many of you obviously know who we are, but just a quick update, because I think this is important right now. With H.R.1 and all the changes that happened in H.R.1, a lot of it impacted specialty tax. Obviously, there's a lot more as well. But when we look at that tax planning in general, H.R.1 affected pretty much everything we do. And what we do is, cost segregation, R&D tax credits, renewable energy credits, some other energy incentives that revolve around property. And all those had some kind of impact. And there's the list of there. Everything that we do, cost seg, commercial energy, renewable energy, advanced manufacturing, which is a pretty cool area as well, which Barry will touch on a little bit today, 45X for sure. And then research. And so this is our offerings. We partner with accounting professionals, tax professionals around the country, based on educating them on these opportunities so that they can go to their clients from a tax planning standpoint and bring these opportunities to their clients. We're really happy to be able to do that for tax advisors around the country. The reason you see 178D and 45 with a red box around it, pretty much in this presentation, when you see red, that's a major indication that something has changed significantly in H.R.1. For this slide specifically, these have a looming deadline on them. 178D was a permanent part of the tax code. That is going to stop fairly soon. We'll dig into that deeper later when we get to those slides. And 45L was always renewed every few years. That has a looming deadline as well. So we'll talk about that. But the rest of those have something. Learning objectives, we really want to go into the tax planning aspect of what you need to be talking to your clients about today before you get into January 1st and start looking at filing their taxes. And I know you're all, tax advisors. I know you all are, proactive with determining what your clients need to do. And so hopefully we give you enough information so you can proactively have discussions with your clients of what is going to affect them going into this next filing season. Next slide. And here's just some ideas, and we're going to dig deeper into this, but what you look for, who's the client base you should be thinking about? What is the new looming deadlines? Were there major changes in renewable energy, which we all heard was going to happen? Probably not as many as you thought, but there are some looming deadlines in there as well, where there's some things that are going to expire that Barry will expand on, and how we plan for that. Understanding client sustainability objectives. Does this fall within what they're doing? How do we reduce the tax burden? How do we use what happened in H.R.1, to transform a client, transform them from, where they are today to where they want to be. And tax savings can be a big part of that. Barry will get into, the PWA requirements. There's some new in H.R.1 around, foreign entities, the FIAC rules, and prohibitive foreign entity rules. Barry will expand on that. And then monetization of renewable, that Barry will spend some decent time on that. I keep saying Barry because I'm just going to do about 15 minutes and then I'm going to hand it over to Barry. Next slide. This just gives you an idea of what H.R.1 included. You see the one that goes all the way to the right. That's where we're going to be talking about today. That's the a bunch of the tax relief and tax incentives areas that we'll dig into. Just a slide for your behalf, but let's move on so we can get to the meat of this. All right, I'm gonna, like I said, a quick on these before Barry gets into renewable. And the reason that we talk about R&D is because R&D tax credit did not have a direct impact, although it did in some areas. I won't have a lot of time to go into that. But there was an indirect impact from the standpoint of 174. And I could talk about 174 and R&D in the same, R&D tax credits in the same breath. Many of you know, starting in 2022, we had to capitalize R&D expenditures. It just kicked in. It was a rule that was defined in the Tax Cut and Jobs Act. That put a major damper on your clients investing in R&D. And that damper has now gone away with H.R.1. We can now expense R&D expenses as incurred. And I'll define that a little bit deeper in a second. But what I want to point out is you have clients that probably took a credit in the past. Many clients stopped taking the credit in 23, 22, 23, 24 because they were not investing in R&D, or at least that's what they told us, but they were not. That's my cynical part of that right there. But now we're seeing a major investment in R&D going on in the U.S. It's just, we personally are seeing it from the number of clients that are coming to us now. And so, in fact, let's go to the next slide, Barry. I'm sorry, back a slide, and we'll go to that in a minute. So I want to talk about R&D for a second, the 174 expenditures. What H.R.1 did is it changed how we handle R&D expenditures from a standpoint that going forward, we can expense them. More so from your standpoint, when you're talking planning with your clients right now, what are the opportunities going backwards? Can we go fix what we capitalized in the 22, 23, and 24 timeline? We can for certain clients. And those clients are clients that have less than $31 million of average gross receipts. And if that's the case, if they fall in that bucket, they have a couple different options on how to handle their past capitalized expenditures. One is they can go back and amend 22, 23, 24 and adjust those returns as if the R&D capitalization never happened. You have that option. You as the advisor, as doing the tax planning, have to decide, does that make sense or not? There's a couple decisions that come into that. One is, well, there's multiple decisions, but one is, are they in an NOL? Am I just going to increase their NOL by doing this? Do I want to increase their NOL? There's limitations on usage. You all know all this. So the analysis has to be what makes sense. The other analysis that has to happen is, and this is, I don't have a lot of time to go into this, but 280C, you're probably familiar with this. 280C election is basically with the R&D tax credit, I have two options. I can either take the full credit, let's say I have a $100,000 credit, and if I do that, I have to reduce my expenses by the $100,000. So the net benefit of the credit is, whatever the tax effect to the $100,000, and it's always tax affected, whatever bracket you're in. But let's assume it's a corporate rate. That $100,000 that I don't get to deduct, I lose $21,000 in tax savings. The credit saves me $100,000. I net $79,000 of benefit with the credit. Now, during the time of capitalization that was defined in the Tax Cut and Jobs Act, I did not have to do that. I could take a full credit without reducing my expenses for almost every client. There was a little caveat where maybe you weren't able to do this, but then the other option was I either take the reduced credit. So I could just take my credit instead of the $100,000 credit, I could take it the $79,000 credit. But again, 22, 23, 24, most of our clients got that full credit benefit. In H.R.1, what it did is said, hey, if you go back and amend, you now have to make this 280C adjustment. And so we reduce some value of the credit. So if you did have a client taking a credit during that time and you decide we're going to go amend to allocate those expenditures and not capitalize them, you're going to lose some of the value of the credit. So that's a planning thing you have to think about. The other option for these clients are, starting at 25 going forward, they get to write everything off, but they can ignore going back and amend, and they can just say, okay, I'm going to write off those remaining capitalized costs in the year 25, or I can spread it out over 25 and 26. So that's a lot of planning. Again, this is a quick recap. I'm already almost over my time. I told Barry I'd go 15 minutes, but let's just add one more thing. If they're over the 31 million, they don't have the option of amend. They have to do the write-off in 24 alone or write-off in 24 and 25. To do this, there's a statement you attach to the return. In either scenario, the small business or the large business, you attach a statement. And that statement basically says, here's what we decide to do. You do not have to do a 3115. One last thing on R&D I want you to be aware of is that you are going to see more credits now, and there's requirements to add a lot more documentation to the application for the filing of Form 6765, which is where you claim the credit. These new rules have been kicking in over the last few years. They were supposed to kick in 24. We got a reprieve that was supposed to kick in 25. We just found out about 5 weeks ago. They delayed it again. These rules are going to kick in 26. Bottom line is these rules are, and just let you know, the polling questions are up. I forgot to do my housekeeping at the beginning, but housekeeping is make sure you answer the poll questions. 3 of the 4 that pop up, and make sure you stay logged in for at least 50 minutes. Your first poll is up right now. Please answer that, and I'm going to keep moving on here. So I don't have time to go deep into this, but bottom line is realize that the new requirements create this. You have to create a nexus between the qualified project and the expenses that go into that project. And all that data has to be put on the Form 6765. There's 2 caveats to that. One, if you're defined as a small business, there's a couple ways to qualify for that. You do not have to put the data on. Doesn't mean you don't have to keep the data in this methodology, because if you get audited, you're going to have it. And then the other caveat is that there's a limit on the number of qualified projects that you need to put on Form 6765, and there's 2 different ways to limit that. So that's as far as I'm going to go on that. You just have to understand this exists, and we can always answer any questions. This becomes mandatory in 2026 unless you qualify as that small business, but still need to keep the data this way. Let's move on. Depreciation. Big thing with depreciation is bonus kicked in. We know that. The other thing that you need to be aware of, especially when we're talking manufacturers, is there's a new, basically bonus eligibility property, and that's qualified production property. This is property that was placed in service after January 19th of 2025 and before January 1st of 29, and it has to be placed in construction started, and it has to be placed in service before January 1st of 31. If you meet that requirement, you have to look at that building, segregate out portions that are not the production property portion of that building, but what we consider production property portion of that manufacturing facility is now pretty much bonus eligible. We get to write that off in 1 year. So if you have manufacturing clients, this is a significant benefit. There is a way for a building that already exists to qualify too. It has to have been in place over like the last 4 or 5 years, but not being used for manufacturing. We have to purchase it during this time and then convert it during this time. And if that's the case, we can qualify for this QPP as well. And then one last thing I want to mention before I hand it to Barry. Wow, I am almost going to hit my timing. 179D, which is the energy efficient commercial building deduction. The client you need to think about with this is anybody that owns a commercial building and anybody that designs a government building or a nonprofit owned building. This is like accelerated depreciation, but the designers of the government building or the nonprofit owned building get this deduction allocated to them. So it's a free deduction, a Schedule M adjustment. The reason we're bringing this up is H.R.1 is basically eliminating this. We have to have a property under construction by June 30th of 2026. That construction has to be 5% complete. And if we have that, then we can still qualify. So from a planning standpoint, you need to talk to your architects, your engineers, your commercial building owners, and find out if there's a project that would qualify and what the construction dates are for this to see if we need to accelerate anything. And then the last one I'm going to spend a couple minutes on is 45L. 45L is a credit for developers of residential property. This has basically a drop dead date. This residential property has to be placed in service by June 30th of 2026. So it's not construction started like 179D. This is a placed in service date. And so if you have any real estate developers, the discussion you need to have during planning season now is, do we have projects underway? Do we think these are going to qualify? Because they're not going to qualify. There isn't a sense of urgency. So we need to do a pre-analysis. But if these projects look like they're going to qualify, is there any way to accelerate as many of these projects as possible to see if we can meet that June 30th of 2026 deadline? That was a major change, 179D and 45L. Those are the ones that are being eliminated in this first aspect of things I'm talking about. And with that, I am 1 minute over and I'm handing it over to Barry.
Yeah, you went 1 minute late, Randy, but really good job. Good job. Good job. Okay. Just throwing up this slide here from H.R.1 and how it affected some of the 3,800 general business credits. Reason I like to put this slide up is because we're going to talk about the energy credits, and just like R&D, WOTC, 45L, these energy credits, they'll have their own forms, but ultimately they flow through the 3,800 general business credit, even if they're not for profit or for profit, whether they're going to use elective pay or sell the credit. So we'll get into some of these different programs and calculation and timing. And I think in the tax planning slide we had at the beginning, it was like, well, like, no, you should know when things expire and when does your client have to begin construction? When do they have to place in service? So what we did is we made a fancy little chart here, a little cheat sheet for you. You could take this away. We did add, like, all the credits are kind of on the bottom, the 3,800s, but we put 179D and 45L. 45 and 48 were the original renewable energy tax credits starting in 25, 45Y and 48E. A lot of what we're going to talk about, the different technologies, are just following under 48E. What the H.R.1, the one big beautiful bill, did is the energy efficient building, 30C alternative fuel, that's the charging stations, and then the big two technologies it put a shorter timeline on were wind and solar, and we'll get into those in a minute, but they are on this chart if you need to use this as a cheat sheet. And just going through here, there's a lot of numbers and letters, but if you look each one up, it'll give you a quick definition of what it is and see if your client qualifies. What we're going to do today is we'll dive into a couple of these just to show the experience that we've had and what the result is for the clients. And then, of course, the question is, what good is a government incentive if you don't actually get the dollars back, either in reduction of tax or a check? So we'll go into the monetization of each of these and show just why they're so powerful as programs for the government to invest in renewable energy. So for us, this is under 48 cap. There's 48 and 45. One's a PTC, ITC, but a lot of the technologies we're seeing, of course, we have a lot of solar projects. A lot of solar now have battery. So under energy storage, there's three types. We see a lot of battery. There's a lot of thermal energy storage, and the thermal energy storage, if your client has a building and they're putting in a chiller, chillers qualify. There's a lot of different technologies under thermal energy storage. So might need to peel the onion back on what types of products are actually being put into the building. We see a lot of geothermal heat pumps. A lot of schools in the north. We're working with a lot of schools on geothermal projects. Another one, waste energy recovery. This is using waste heat to generate power. And so these are some of the technologies that we're working with, and you can try to figure out like if your clients are deploying any of these technologies. So of course, solar, geo, battery are the top three. And if they're a little bit bigger clients, they'll get into waste energy, some combined heat and power. So just some technologies to look for. Like, we're going to go through these pretty quickly because from the Inflation Reduction Act through the One Big Beautiful Bill, for the most part, a lot of the calculation percentages and the amount of the credit available, a lot of them remain the same. There were some caveats in there. However, most ITCs are a 30% tax credit. If you're under 1 megawatt, it's automatically 30%. If you go over 1 megawatt, or larger in size, you have to meet prevailing wage in order to hit the 30%. If you don't hit the prevailing wage, it's a 6% credit. So you could kind of think of, this prevailing wage, it's a 5-time multiplier. Same with 179D or 45L. It's a 5-time multiplier of the credit if you do meet prevailing wage. Same rules, same math across those different programs. And the prevailing wage and apprenticeship, we're feeling this will be an area of contention if the IRS is going to audit it, and we feel that it's very, very critical to follow these rules and absolutely meet not only the prevailing wage to meet the Davis-Bacon rules, but also the apprenticeship requirements. What we've found is working with third-party software providers that track real-time payroll, especially. We have some extremely large contracts. They have subs, and those subs have subs. And, it's just how many journeymen versus apprentice and electricians are on the job. It's extremely complicated and extremely important to meet those requirements.
And then I just want to and you said it, Barry, but just so everybody knows, just to sink it in, under 1 megawatt, we don't need to worry about the prevailing wage. Over 1 megawatt, that's where we need to get to the 30% credit.
Yep. Yeah. So most of our projects don't have to meet prevailing wage, but we do have some large ones where we've partnered with the software company to absolutely make sure it's buttoned up. Again, these are the programs that are going to require it in order to get the larger tax credit, and then the other bonus credits. So the funny thing here is there's been so many changes and executive orders, and there's just been a lot going on. So if you see a red line, like Randy said, we're just kind of taking the slides and just saying, okay, here's a new change, here's a new regulation, here's a new rule. So the bonus credits remain the same. Low income, pre-application, either 10% or 20%. Energy community stayed the same. It is a requirement. There's 3 different areas of qualification. Some require, additional verification on the unemployment rate. And then domestic content, also, this is probably one of the larger areas of contention or confusion or like how do you qualify? So the domestic content, you have to qualify on the project level. So what components go into the project, but also at the manufacturing, at the product level, where's the product? Is it manufactured? Is it substantially does it meet the substantial requirement to be in the United States, or is it just assembled? So there's a lot going on within domestic content, and the OBBBA, it adjusted the percentage a little bit. They called it a fix from the IRA, but so there are safe harbor rules for certain technologies as well. But at the end of the day, if you have if you're under a megawatt, you have a 30% credit. You meet domestic content, that's a 40% credit. Energy community, 50% credit. Low income can be up to 20, 60, or so potentially there can be a 70% credit, which is significant because these 10% this is 10% multiplied by the qualified basis. So the capital expenditures that are qualified is going to be multiplied by 30, 40, 50%. So extremely significant dollars on the table. You look at the R&D tax credit, 20% credit with a limitation, it comes out to be about a 10% credit against tax. Some of these credits, we're running a lot of 40, 50% credits that are monetizable, either refundable from the government or can be sold on the market. Another polling question, making sure everyone is still here. If you want your CPE credits, you can choose C, huh? And if Barry talks about FIOC, you can just choose huh. And anyway, I'm going to keep going. So there's a lot of words on this page, but we just wanted to put what some of the changes were between the regular 48 credits going into 48E, which is technology neutral, net zero electricity credits. But if you look under here, a lot of the technology tax neutral credits, the government does have technologies that are inherently net neutral, storage, geo, biomass, hydroelectric. So some technologies like geothermal from the Inflation Reduction Act, they still have until the end of 2032. And then other technologies had to follow 48 cap E, which is the net zero requirement. Under their solar specific, solar is probably the number one technology you'll see your clients have. So like Randy was explaining before, so it did cut it. So if your client is going to invest in solar project, they have to begin construction within 1 year of Trump signing the bill. And if they do, it allows them 4 years to place in service and claim the ITC. If they do not place by July of next year, then they have to do it by 12/31/2027 or prior to 2028. So for the smaller projects, there's still plenty of time. For the larger projects, there has to be a beginning of construction analysis, and those rules change a little bit too as well. So it's a little bit more confusing. And then this slide here, we are waiting on more guidance. And as Randy was saying, foreign entity of concern, specified foreign entity, foreign influenced entity, foreign influenced entity. These are what's called the FIOC rules or the FIOC maze, because it's a what's the game, Plinko? You go all the way down, like, where is it going to fall? How do you get through the maze? When I read these, I kind of summarized it kind of in 3 steps, kind of the beginning, middle, and end, where they want to know if there is any foreign influence only of the country's entities of concern. So in the beginning, it kind of looks at entity ownership. Who owns the property? Who owns the entity? Is there a project entity? Is there foreign ownership? Then in the middle, on the project, the products of the project, it wants to know what's the ratio of components of the project. Where are the components coming from in that renewable energy project? And then on the end, there's some rules too. Under contracts, there's technology license, project control. Like after the project is up and running and generating renewable energy, what is that ownership? Did you sell the credit? Did any one of these foreign entities of concern have any interest in the licensing or technology or project control after placed in service as well? So the way I say it, it's kind of like, what's the entity, and then what's the project, and then how does it work afterwards with intellectual property? So those are the FIOC rules. I'm sure there'll be another webinar on this when we get the final guidance, and it'll be, it'll just probably be fairly boring and sensitive, but if we can come up with a FIOC maze solution, it's like a corn maze, you got to figure out how to get to the end. Okay.
We're going to gamify this.
We're going to gamify it. Yes, we are. You get 3 lives, but you can get extra lives if you do meet certain parameters. So just really quickly, we love the 45X. This is advanced manufacturing. We've been manufacturing advocates for as long as we can remember. So 45X is creating any of the components that go into the renewable energy project. So this is a facilities-based credit, and it is a PTC, so there's not going to be any recapture on it. Interesting thing about 45X is it is refundable even if you're a for-profit client. So very, very lucrative credit. what happened with the OBBB was it cut wind. Solar component stayed and wind got cut, and then it added metallurgical coal, which goes into making, steel and metal. So this is what was cut from the OBBB. Again, we're just kind of redlining here because as the changes are happening, added metallurgical coal. So this is a PTC. So if your client is making any of these components or parts, there's a dollar amount per part produced and manufactured. At the end of the year, that production tax credit can either be sold to another unrelated party, or it can actually be refunded. A lot of the companies are choosing to sell the credit and monetize it with the 6418 transferability rules, because they're going to get 90 cents on the dollar faster than they would a refund from the government at 100%. So I guess the time is money. Here's another one. We took out the 48 cap C, which is we're working with many of those clients, but the application process ended. So we do have 48 cap D in here, which this comes from the Chips and Science Act. And so there's an ITC. So if your clients are making semiconductors, they're going to qualify. Or what we're found is even just making the manufacturing equipment used to go in to make chips, if you're part of that supply chain, technically you can qualify under the 48 cap D advanced manufacturing credit. So, we work with a lot of manufacturers, a lot of, so anyway, we've found a lot of clients that did not know that, they could qualify because it, was going to their supplier. So it did this in the CHIPS Act. We thought it was going to get cut, and it actually became more lucrative. So this is very, very, very good credit, solid credit. If you have a client that's thinking about changing some manufacturing or equipment that will go into making chips, this is highly, highly encouraged. I don't know if you ever look at what supply chain and what the challenges are out there. It is, we need to manufacture more chips. It is absolutely critical. So I'm going to jump into the monetization piece. I have about 27 minutes left. So this here, again, like what good is an incentive if you don't actually get the dollars, right? If the taxpayer actually, reduces the tax or receives a check, it makes the program worth it. And that's where we have had a lot of success with the transfer and the selling of the credits, and also with the not-for-profit clients receiving checks from the government. So I'm going to quickly go through both of those processes that we've built out, and starting with the not-for-profits. So elective pay, if you like all of these programs, so the programs are kind of on the right of this table. 30 cap C, that's the charging stations. You can see 45X in there. So basically it'll say what type of organization are you? Are you a government? Are you a municipality, not-for-profit, C-Corp, partnership, REIT, sole proprietor? And if you're either applicable entity, you're going to use elective pay. That's going to be a P. Or if you're a for-profit entity, you can use transferability. That's going to be a T. So this kind of defines, what your monetization options are. So if you see a P and a T, so 45X, if you go down, you'll see it says P and T. You could choose. I'm a tax-paying entity. I can either sell this credit or I can apply for elective pay. So what is elective pay? This is applicable entities, literally local governments, co-ops, any not-for-profit entity, agencies or instrumentalities of the state. We have a couple like governments and cities and territories that are claiming these credits. So then you have a process of identifying the credits. All of both T and P have the IRS portal registration. I'll show you how that, just a high level of how that works. And then the due diligence process, and then making your elective pay. So if let's say you're doing solar, the 3468 is the form that will take that technology and calculate the credit. It goes to the 3800, and the not-for-profits, they have a 990. They're going to file a 990T, which I'll kind of go over that at a high level. So outside of the tax return and the tax entity structure, you have to register with the IRS portal. What this is doing is it's going to triangulate the tax returns being filed and the registration number with the IRS portal with the actual project, the latitude, longitude, ownership of the actual renewable energy project, registration number, and the tax return, whether it's a 990T or a for tax entity filing that credit that got transferred. So this is critical for any client trying to claim the credit. They initially asked for a 120-day period, and even now with the shutdown, longest shutdown in history of the government, we are receiving these a lot faster than 120 days. So you apply with the IRS portal. You say, I'm a not-for-profit. I have a renewable energy tax credit. I'm gonna claim a refund. They look at it, communicate back sometimes, and they give you the registration number, and that's how it works. So if it's last minute, you may not be able to file for the tax credit. And side note, both not-for-profits and for-profits, if you want to use elective pay or transferability, has to be on a timely filed return. So the not-for-profits, this is, and you can take these slides away and look at them a little bit, but it's basically the 990T is the mechanism for receiving the tax credit from the government, along with whatever form your technology requires, and the 3800. 990, it'll have, you can see right here, it says 6417. I am an applicable entity, and that's what I'm choosing on my 990T. And then there's a filing process, elective pay amount from the 3800, so it all kind of lines back to the original. And then if you have questions, you can write an email to irs.elective.payment. or .transfer. Anyway, that's a silly tax joke that no one laughs at. If you're laughing at it, you are a fantastic CPA. Anyway, that's the communication. So here's a couple examples we've been working with. A school district put in geothermal heat pumps. It was a $4 million geothermal system that qualified. 1.2 million. They achieved domestic content, no energy community, and no bond financing adjustment. So they're getting a check back from the government for $1.6 million. I mean, it's awesome. It is awesome. So a hospital, this is a big hospital. We actually need to revise these numbers. The final numbers were a little bit larger, but $150 million remodel, 30 million of it was a combined heat and power. Are you still there? We got another poll question coming up. So they're going to be receiving a $9 million check. This is a community center, thermal energy units, $3.6 million check. I mean, it's just, so yeah, thermal energy is, I mean, you can use chillers or chilled systems, or, there's ice. There's a thermal energy is really any HVAC upgrade potentially has a thermal energy storage property in it, which is kind of unknown to a lot of taxpayers. Really great projects. And then a community center, another geothermal project, $840,000. Project to check. So the goal is, what's going on in that building? What are those pipes? Those pipes qualify. What is that? How do we identify what your client's doing? If they're, having a new build or a renovation, a remodel, HVAC upgrade, whatever they're doing, if any of those fall under any of these qualified technologies, through the process I just explained, it has a check. And it's really, really awesome to, I mean, not only, I mean, you're going renewable and getting help for doing so. So it's been really, really, really awesome. Okay, going to shift gears. About 20 minutes here to talk about the transferability side, which is also been really great for our clients and your clients as well. So it follows the same process: eligible credit, due diligence. You're going to go in and file with the IRS portal, get that registration number. You're going to arrange to sell the credit. So if you're a for-profit, let's say it's 3468, 3800, you create this thing called a transfer election statement. Then you find a buyer sends cash. And basically what happens is The seller has a 3,800, says I elect to sell this $1 million credit. I put negative $1 million in my 3,800. The buyer says, I just gave them $850,000 for a $1 million credit, and they match the 3,800s, the same registration number, the same credit, positive, negative, transfer election statement, and then they both, and that registration number has to match, and then they both file the 3,800s. And that's how the transfer takes place. The credits that are eligible for transfer, this is, that list that I showed before, it's basically most all of the credits. They added a small agri-biodiesel producer credit. Sounds good. So most of them are going to be under that 48 or the 48 cap E. That's where all those other technologies are: thermals, geothermal heat pumps, geothermal energy, thermal energy, battery, battery storage. Really, really easy one to pay for and qualify for. So when the IRS put out the rules, they said, okay, here's the process. And in my opinion, this is very, very simple process. Like, they just say, okay, go get a registration number, right? Make sure you check all the requirements. Place in service date has to match with the tax year end of that taxpayer. Identify a third party, receive cash. Make sure you both have the registration number, transfer election statement, file your returns. So that's literally the recipe from the IRS. So transfer election statement, generally to include, that's the list they put out. So every transfer, if your client has the credit to sell, it'll have this information, a transfer election statement. If your client's buying a credit, they're gonna receive this election statement in their return. I like pictures. What you need to know is there's eligible property, and then there's an eligible credit and the eligible taxpayer, all on the sell side. And then when the credit goes over, the buyer becomes the taxpayer. So if it's a PTC, there's no recapture, so the buyer's good. Those credits are a little bit more expensive because they're more attractive. The ITCs, they will have a 5-year recapture period, and if it gets audited, it will audit the taxpayer, which is the buyer. And so if your client's buying the credit, make sure they're buying good credits. Make sure they know what they're getting into, and something we could definitely help out with. So just looking for buyers, it just depends on what your kind of buyers. It kind of shakes out to, if you're a larger firm or a smaller firm, you have multiple buyers, or you want to do one-to-one, it's basically matching up. So you can take one credit and divide it up, or one purchaser can buy multiple credits. Just each one will have the same registration number. Every single property will have a registration number 3468 to be purchased. So you can divide it up or buy multiple ones. Just here's a placement process. If you're a CPA or tax advisor and you have clients, it's, you got to have a scoping call with your client, and there's a couple of things to understand there. It is, one, what's that client's tax appetite? And then two, what's the risk profile of that client? If they're want very low risk, then you're going to want to go for PTCs, or you can have insurance on credits. There's going to be a different type of credit for each buyer. Matching the buyer, and then a lot of times what will happen is if your client is the buyer, it'll go in a term sheet with that credit. So the seller won't sell that credit. It'll give your buyer time to do the due diligence process on that actual asset. Who owns it? How was it financed? What's the entity structure? Is it insured? Is it a PTC? Did you take domestic content? Did you meet PWA? Like, there's a diligence package that your buyer is going to want to check these boxes to make sure it's a great credit. So you could go to your client and say, this is where you find what's the tax appetite of my client. One thing to know, actually, I have called What You Need to Know, another dad joke. Sorry about that. The other is a CPA joke. This is a dad joke. The only other dad joke I have. So what you need to know. So all credits have to be sold to an unrelated party. So both entity, the control group, consolidated group rules. parent, sub, brother, sister, all those rules apply. And then also the other rules of cousins. Everyone remembers the ERC credit, the ERC days, right? Like, is it a cousin, brother, sister? Is it a so both of those rules apply to this. It has to be an unrelated party. You can only transfer on a timely filed return. There are 3,800 general business credits. Their rule is back 3, forward 22. So one of the biggest rules is C Corps can offset income tax. Any flow through entity, all your 1120s and 1065s are subject to the 469 passive activity loss limitation rules. So basically, flow throughs only offset passive income. So that is if you have clients with tax, if they're C Corps, that's easy. They're going to offset income tax. If you have any flow through entities, you got to look for, I don't know if it's the 80, 85, 82, but you got to figure out what's passive income, because these are going to flow through as passive credits. Special rules for partnerships and S corporations. Credits can be added for one buyer or divided. 5-year recapture for all ITCs, pre-filing registration, and all transfer are made with cash from the buyer. So cash on hand is also important. Something you want to know when assessing your client. Here's an example of a credit that we actually did the work on, Holyoke, Massachusetts. This was a combined heat and power project. Just to give you an example, $3.4 million credit. It sold for 86 cents on the dollar. It was insured. So what we provided was the due diligence package, 3468, 3800. Transfer election statement has information from both buyer and seller. So just to look at some other credits here and pricing considerations. So again, I would say the number one pricing consideration is your client's risk tolerance profile. What is your client looking for? We have worked with some clients that they say, 1% risk is too much for us. We have very, very low risk. And then there's some other clients out there that are like bargain hunters. They have a lot of tax. They don't mind risk. They want to pay 80 cents on the dollar or less. So it just kind of depends on what type. There's a lot of different types of credits out there. Any of your 45s, your 45X, your 45Qs, your 45Zs, a lot of the larger credits, they're going to go, some really large PTCs are selling 94 to 96 cents on the dollar. So that buyer profile is large enough to only need 4% of their tax bill with no risk. So if it's $1 billion, 4% of $1 billion, tax bill is big, right? So those are really large credits. The smaller PTCs, 90 to 92 cents on the dollar, that comes down. The credits can be smaller and lower risk as long as the client's willing to only get 8 to 10 cents on the dollar. That's fine. And then there is insurance on these credits. So if you want to put recapture insurance on it, you can do that. And what's good about that insurance is their due diligence process has a lot to do with, of course, indemnification and all these other things that they look for, like who's the seller, what's the financial security of the seller, what's the technology, what's the risk of recapture, what's the risk of this technology not working. Like if it's insured, it'll have a lot of those boxes checked on, what the risk of it is. So other ones are, the market demand for the first 2 years. There's like a little bit more buyers than credits. And right now for 2025, there's a lot of credits to choose from. So bringing the buyer to the table, the buyer might have a little bit more advantage. I hate to say it's like the real estate market, but it is, right? It a little bit is. Is it a buyer's market, seller's market? It's a little bit of like, what does the seller think they can get for it? And a lot of these are going for high prices. A lot of them are coming down just because there's a lot more credit. So there's competition on the sell side. And then of course the negotiation of the location, program specifics, there's a lot to go into it. And then here is like just there's a lot of Like Tri-Merit has credits. We have some channel partners that have credits. There's actually credit exchanges out there. There's a lot of options. And again, it's a little bit of buyer beware, like know what you're getting into, know how to know what your due diligence checklist looks like, know what questions to ask. But I mean, anywhere from smaller credits to a couple $100,000. I think we have our last polling question up here too. So again, knowing what to bring to your client. If they're willing to get insurance, if they're unwilling to get insurance, the seller comes out of pocket for the insurance. So at the end of the day, there's the gross credit. That's what the buyer sees. If they see 92 cents, they're getting 8 cents. It doesn't matter how many administrative fees and insurance come through it. And then the seller gets the net fee. So, like 43 million, I mean, there's a lot larger credits. There's gobs and gobs of credit that add up to $45 billion. I think it changed hands last year. We'll see what it is this year. It's a lot. But for you got to understand what one, does your client have tax, and can they have tax offset? And two, do they want to do it? Is it something that's worth it to them? Let's say you're going to save 15 cents on your tax bill. Okay, what's your risk? And then you go in and try to place the credit, and then everything else kind of is the administrative process to make it all happen. So tax planning strategies. Again, this is just a repeat of the first slide. What to look for? Are your clients something with the building? Are they buying? Are they renovating? Is it an HVAC upgrade? Are they doing anything renewable? Do they have any sustainability goals? Is it something they want to look into? Do they have any? Are they going to invest? Is it going to be within their organization side? Like, are they looking in the energy space? Any key strategic changes? Any future growth coming up? And then, of course, some of these go into just make sure if your clients are involved in some of these credits, are they checking all the boxes on diligence of the actual credit? Is the qualified basis calculated correctly? Are they taking tax-exempt bond financing out? Are there grants? Was it a loan? What was it? A special vehicle? Was it FIAC? Like, what are all these rules? Domestic content, all the bonus adders. And then understanding the monetization. That's why we put the monetization wheel up there in the beginning. If your clients are embarking on an energy project, or they already have, or they put in geothermal, or they did battery, and like, what's the monetization determination is probably the first question. Are you a not-for-profit? When is your tax year end? Do you file a 990? Do you have unrelated business income? What is do you go on extension? What is the final date? And when is your project placed in service? We're finding a lot of not-for-profits that, maybe did thermal energy and didn't know they qualified. They placed it in service in 24. Like, is it still open? Because if they don't do it timely, they're going to file timely, they're going to lose it. And then, of course, on the either sell a credit or buy a credit, there's all the rules on the transferability. So I think we have about 6 minutes left. And
I have a couple questions if you got time.
Go for it.
Okay, so I got this question. Does domestic content for solar get you a 40% credit? What is the requirement prior to the change?
Yeah, so the domestic content is the same. The rates of the percentages, which starting in 2027, it'll cap out at 55% of all of your components must be domestic in order to qualify. So 2026 is 50, 2025 is 45. So it does get more and more every year, but it is still a 10% bonus. So if you're under 1 megawatt and you do meet domestic content, you will get a 40% credit. The domestic content makes up 10% of that calculation.
Right. It's not a 30 and then 10% of that. So I get 33. It is a 30% credit and I get an additional 10% credit. So I have a 40% credit, which I think was the question. Now, going forward, H.R.1 changed the percentage of domestic content each year that needs to be included. You said in 2007, it's 55. It does go to what, 45 and 26?
26. I think it caps at 55 and 27.
Okay.
It's
so
5%.
those rules are there. It was 40, domestic content plus 100% U.S. steel. Those are going to up every year. So you just have to watch what's going on each year to see if you can get that 10% bonus on domestic content.
There are safe harbors for certain technologies that make it a little bit easier. So look for that as well.
And then the other thing, because this question was specifically solar. Solar is actually sunsetting from a credit standpoint. And what's the date of the solar going away?
So if you begin construction by 1 year from the date Trump signed the bill, so next July 4th of 2026, if you begin construction, that allows you 4 years to place in service and take the credit.
Okay.
So it'll be
and that's both solar and wind.
Yep.
Solar and wind follow those same rules. Everything else pretty much not changed on that.
And then for solar, if you don't begin construction by next July, you have to do it before 2028 to place in service, to have in service.
Okay.
Yeah. So you might see a lot in 2027. You might see a lot of these smaller solar projects being deployed fast as possible. Yep.
From a planning standpoint, tax planning, it's just the question. If someone's talking about this. And then another question came up about our brokers connecting buyers and sellers for transferring credits.
Yes, there are brokers in the marketplace. There's a lot of different types of brokers. So Tri-Merit actually does this as well. If you want to talk to us about trying to place a credit, we have credits and broker credits as well. But there are a lot of different brokers in the marketplace. And you have to find the ones that are right for your client. Some of them only like very, very large credits, 50 million or above. Some of them play in that mid-market space, 20 to 40 million. Some of them will go down to, 100,000 credit to 5 million. So there are brokers. And I think the key is, one, find out what size and type of credit your client's looking for to find the right broker. And, so that's the advice there. But yes, there are brokers.
Okay.
Yep.
And then no more questions coming in. So I just want to do a quick recap, and Barry, you can add to anything. But bottom line is we're in tax planning season right now. There's a lot of new opportunities you have during tax planning season for the next, 8 weeks, 9 weeks till the end of the year. Just to kind of reiterate the key things you need to be thinking about in this time. 174. No longer have to capitalize. How does that affect our clients? Is R&D credit now an option for our clients? And that specifically manufacturers, software developers are probably the two biggest users. I bring up manufacturers because then we did talk about QPP, qualified production property. Again, that's going to be for manufacturers. There's a potential credit for bonus on a specific part of the building for new construction for those. In addition, I'm going to highlight manufacturers. 45X, Barry touched on. 45X is a production tax credit for manufacturers that are producing components that go into renewable energy equipment. That's another opportunity. That is also could be a refundable credit. And so those are opportunities you want to talk about. The key things then when we're in tax planning season as well is those drop dead deadlines on 179D and 45L. June 30th is a date to remember of 2026. 5% construction for 179D has to be completed by that time. It has to be placed in service by that time for 45L. So, those are questions you have to have with clients right now during tax planning season, because those are probably the most pressing if that benefit exists for those clients. And then going on to renewable, the tax planning opportunities, the things you need to be aware of are everything Barry just talked about. From a deadline standpoint, it's that wind and solar, and Barry just gave you those deadlines of those dates that you need to place in service. Just talking about, are we putting the solar or wind into place, and what are the deadlines, and make sure that if we expect this credit, this available, that we meet the requirements from that. A lot out there. You have a lot to do right now with all of your clients to get prepared, not only with this, but there's obviously other things that came out of H.R.1 and then just tax planning in general. Barry, if you have anything to add, otherwise I'm going to close it up.
Let's wrap it up. Thank you all for joining. Yep.
Yeah, thank you. We appreciate it. Look out for our next one. We'll be announcing that. I don't have a date yet, but just as a reminder that Bridging the Gap Roadshow, first one, November 12th in San Francisco. Reach out to us for more info, or again, Cal CPA will have the registration link. We're co-hosting that with them. I want to thank everybody for being part of this. Appreciate you being here and hope to see you soon.
All right, man.